Okay, so we're moving on to a next section from T accounts. These are called journal entries. They're basically doing the same thing as T accounts, but they look like they're in a different form. And these journal entries are a lot like what you will see in a journal entry in QuickBooks. Let's say you were the accountant, you make the journal entries. Now, an accounts receivable clerk usually doesn't make journal entries or accounts payable because they usually only work with paying bills or taking in money. But the bookkeeper, the account has to make journal entries. And this is kind of what it looks like at QuickBooks. So when we get to the journal entry part, which is it for a while, this is what it will look like. But journal entries are the same principle as using the T accounts, but it's more in a horizontal form and you can fit more. So normally my class would have watched a video about this and they would have gotten a background, but we're going to jump right in. Okay. So here's the journal entry. City Express was paid for an ad placed in their newspaper on April 1st. They're looking for an assistant. So for a journal entry, you always write the date. And here's the detail. You always, I said it before, you always record the debit first. It's debit and then credit. That's just the way accounting goes. So we're going to debit advertising. Yep, over here on, oh, this is just a reference, journal entry reference. But you're going to debit, and you don't have to worry about that. Debit advertising, debit advertising. See, it's under the debit column. And you're going to credit bank account because advertising expense was debited, it went up. And your bank account was credited, so it went down. And then you just put the description right here. Okay, let's see another one. On April 2nd, a rent deposit was paid to the landlord. So we paid rent. I don't know why they call it a deposit. Rent was paid to the landlord for $1,000. Now this is an expense because it's in the normal course of a service in the normal course of business that we're paying for. And so we pay rent expense, we debit. Debit means make expense go up, $1,000. And does our bank account, when we pay rent, does it go up or down? It goes down because they take the money out of your bank account. And so it's under the credit column here. So see how it's sort of like a T account, but it's going this way instead of going this way. One more. On April 3rd, $110 was paid to this power supply company for the connection. They're just saying we're paying the bill. So our utilities account is an expense. So do we debit or credit to make the expense go up? We debit because debit makes expense go up. Remember I said you had to memorize it? So see here, debit makes this expense go up. And bank account, did our bank account when we wrote a check to the utility company, did it go up or down? Went down, right? Because they took our money. So we credit. Credit means your bank account is decreased. These are what are called journal entries. I just wanted to show you an example of journal entries. Now here's another video. And this lady shows how to do journal entries, and she explains it really well. It's 8 minutes. So if you wanted to watch it, this is in the student resources, okay? So we're going to do journal entries. That was for expenses. Now we're going to do sales, okay? Just for practice. This is giving us practice to get it in our mind how do journal entries work. So $850 of cash at checks was deposited because those were for the sales for the day, okay? So it was April 21st, and they're the sales for the day, and we are going to deposit them, okay? So what happens? First, we're going to do the debit. Now, our bank account went up, right? And debit means make an asset go up. So we're going to debit our bank account. And on revenue, what makes revenue go up? Debit or credit? Credit makes revenue go up. So people paid us money and our bank account went up. So we credited sales for $850. Okay, more sales on April 22nd. Our bank account went up, so we debited it. Our sales went up, our income went up, $980. And again, more sales. So our bank account went up $325 and our sales went up $325. So that's how you do a sales journal entry. Now, sales and expenses are all done in QuickBooks. It's called behind the scenes. So you're not going to see this until we get to journal entries because QuickBooks automatically makes the journal entries for you. But I like you to know what's happening behind the scenes because if you just stayed as an account payable clerk or an accounts receivable clerk, you would never have to know journal entries. But there will come a time where you want to be promoted to the supervisor, right? And the supervisor, the bookkeeper, needs to know how to make journal entries. So that's why it's good to know behind the scenes what's happening. Now, when we had paper and pencil, we had to do it this way. But with the computer, if you're accounts receivable clerk, you'll just see an invoice that you're making, sending it to ABC company that they owe us $500. Or if you're an account payable clerk, you will see an invoice someone gave us, you'll record it and you'll write a check and pay the bill. So you will never see the journal entry because you'll see a screen that does it all for you. But remember what I said, if you want to ever get promoted, you will know how to make journal entries. So that's why I'm just giving you a taste. You actually don't even have to memorize this till we get to journal entries. Okay, so this is assets. So $1,500 was paid. So this is a flour company, I guess. Yeah. And they paid $1,500 for stock. So their inventory went up by $150,000. Now, inventory is an asset. You own it. Remember, asset means you own it. So inventory is an asset, and it went up by $1,500. So you debited inventory. Well, did our bank account go up or down? It went down because we paid. Let's say we wrote a check and we paid for the flowers. So we credited our bank account. Then we went to Office Supplies, Inc. And we went and we bought a desk chair. So we debit office furniture and we credit our bank account because we paid, right? And then IT Experts was paid at $145 to set up a new computer. And we paid them $350 for software. So we paid IT Experts, which is a technology company. Now this, I don't know if you remember, I mentioned debits have to equal credits, but sometimes it can be split. This is called a split transaction, but it still balances. So they bought plant and equipment. I guess plant means for your company of $845. And they Okay. The asset here is a computer, not the software. Okay. So, and then they had a computer expense of $350, but they wrote one check to IT experts. They wrote one check for $1,195, but it was for two items, right? It was for equipment and for software. So this is called a split transaction, but do the debits equal the credits? Yes, the debits equal the credits. They both equal $1,195. So your books are still in balance. Okay, we're going to do journal entries on liabilities. Remember what are liabilities? Liabilities are what you owe. You owe it to somebody else. So Rose secured a business loan for $7,000. So did our bank account go up or down? It went up because they gave us $7,000 on the loan, right? However, the liability is the bank loan, and we have to pay back $7,000. So let's say we had to pay like $100 a month. Every month, the liability would go down. But right now, we owe them $7,000. And I did say if you see payable, you know that means liability. But sometimes it does not say payable and it is a liability. So you just have to know, what is it? Well, we owe it, so it's a liability. Okay, so on April 21st, Rose purchased vases from the vase company, and she said, please bill me. So she took in $250 of vases in her inventory because she's a flower company, and inventory is an asset, and she debited the asset because debit means make asset go up, and our inventory went up, right? But now we owe vase company. We owe them $250. And it's a liability. Whoop, here's the clue, payable. It's a liability. We owe it to them. And on a liability, credit means make liability go up. So the accounts payable went up by $250,000. Okay, so on April 30th, we made a loan payment. Remember I said if you make a loan payment, then your liability goes down. So this is an entry that shows your liability is being reduced. But if your liability is being reduced, well, what happens with your bank account? It goes down because you had to make a loan payment, right? You wrote a check to the bank. And so here's the entry. And remember I said you always put the debit first. So we're going to put the loan. And, oh yeah, bank loan. It's the same, bank loan and loan. They should have said bank loan here. And $325. So do you remember debit makes a liability go down? So if we originally owed $7,000, now we owe what? $6,675. I don't know. My mental math. I rely on a computer now, so. But we owe $7,000 minus $325. So the bank account, it's reduced because we wrote a check for $325. And if you credit an asset, our bank account is an asset because we own it, then your bank account goes down. And so you credit the bank account. So now we're going to make some journal entries with capital and draw. So let's see. On April 1st, Rose deposited $3,000 from her personal money. Now remember, this comes from an outside source into the business. It's just like when we had the two partners and they were each contributing 50,000. And so the capital went up by 100,000. Well, Rose is putting 3,000. So first we do the credit. And the bank account went up by $3,000, right? Because she's taking money from her personal account and putting it in her business. So the business bank account went up $3,000. So if an asset went up $3,000, then the capital would go up $3,000, okay? Next, this is the opposite. A draw, we haven't talked about this yet, is the opposite of contributing money to the business. It's drawing money out. And what a draw does the same thing as an expense. It makes your capital go down. Because let's say your bank account had $3,000 and Rose came in and took out $150. So we debited draw. What happened to your bank account? It went down, right? So we paid our bank account went down $150,000. What means make bank account, which an asset, go down? Well, credit. If you credit an asset, which is a bank account, it means make it go down. So our bank account went down by $150,000. Okay, now on April 27th, Rose took $90 to pay the vet. So this is something you normally shouldn't do. It's mixing your business money with your personal money, but it's not against the law unless it's like a corporation. But if it's just your own business, you could take the $90 and you could say, well, I'll just say it's a draw. It's like writing a check to myself for $90, okay? So draw went up by $90,000, so we debited it. And what happened to your bank account? Well, we wrote a check to the vet, right? So it went down by $90. So this is the journal entry. If she paid her vet, it's really a draw, okay? Time to review. If I make a sale and the customer pays me cash, so if I'm a candle company and you say, oh, give me a candle and I will, here's $20 bill, I'm paying for it. What is the journal entry? What are the accounts that are used in the journal entry? Well, cash went up, right? Because they gave you $20 and you're supposed to put it in your cash register, right? And sales went up because you made a sale. And credit means make your sale go up. So this is another time where cash went up, sales went up. They both went up. That's possible, but the only thing is you have to debit one and credit one. You can't debit both and you can't credit both. If I go to Staples and I buy a computer, let's say it's $3,000, and I tell them I want to charge it, put it on my bill. What two accounts are used? Well, do our bank account go down now? No, because we charged it, right? So it doesn't affect cash. So what accounts does it affect? Well, your equipment went up, right? And equipment is an asset. So debit means make your equipment go up. So we debit equipment. And a charge account is a liability. So we credit what we owe Staples, the liability, the credit card payable. We credit because credit means make liability go up because now we owe them, right? We owe them $3,000 for the computer. Okay, this is the last section. The first section was T accounts. Well, first we explained accounting principles, but then we did T accounts. Then we did journal entries. Now what we do is we need financial statements to see how healthy our company is. Let's say I'm the candle company and I took in sales of 10,000 and I had to pay 8,000 in expenses to make that much. Well, yes, my income is bigger than my expenses, so that's good. That's healthy. Maybe I wanted to make more, but at least I didn't lose money. But let's say it's the opposite. Let's say it's your candle company and your expenses were 10,000, but you only took in 8,000 because it was a bad year and people only bought 8,000 of candles. Well, you had a loss, right? Because you had to pay out more. And you might say, well, how could you do that? Well, remember, she put in $3,000 of her own money. So that's how she could pay her bills. Otherwise, she couldn't pay her bills. So there's two statements that show your health. The balance sheet has your assets and your liabilities. So it shows, if like when I was a financial manager, I would give a balance sheet to the owners and they would say, oh, we have a lot of cash at the bank, right? And then they would also say, oh, but why do we owe so much to the vendors? I think they're charging us interest. Will you pay off these liabilities? So when they looked at the balance sheet, they saw our assets, they saw our liabilities, and then at the bottom, they saw how much equity that we had. An income statement is a different statement. It shows how profitable you are. Did you make money? Like what I was just talking about. Did we have more income than we had to pay out? That is the income statement. Now, the income statement has three names. You'll hear it like this. Sometimes they'll call it an income statement. It's also known as the profit and loss statement. And sometimes it's called the P&L. So if you ever hear P&L, that means profit and loss. Balance sheet basically only has one balance sheet. Okay, so there's a video that will be in the resources that you can watch about financial statements. And I think it would help you if you wanted to know more about it. But we're going to talk about the balance sheet right now. And there is a section in the QuickBooks talking about balance sheets. So you will have to know this, but I just wanted to let you know what's on the balance sheet and what's on the profit and loss. That's all I wanted to let you know right here. So the balance sheet records a company's assets, liabilities, and equity, which is the same as capital, right? And right here it says, as of a moment in time. And you might be like, why does it do it then? Well, because you have to say, well, how much did we have in the bank as of what? As of the first day of the month, as of today, as of tomorrow. So you always have to put one date that it's as of. So that's why they call it a snapshot as of that date. So let's say we're reaching the end of the month and I ran a balance sheet as of November 30th. And they always mean it's as of the end of the day because you're getting sales in and you're paying stuff during the day. They mean as of closing. And this tells me how many assets do I have, how much is in the bank as of November 30th, how much do I owe people as of November 30th. And then remember, assets equals liabilities plus capital. So the capital would be as of that time. So when you run a balance sheet, it always only has one date. And I'm stressing this because the income statement is different. The balance sheet, they call a snapshot in time. What do I own? What do I owe as of November 30th or whatever date? One date that you put. So here's an example of the balance sheet. Here's the assets. It includes current assets, which means things that could be liquidated within 30 days. Other assets such as cars, furniture, equipment. And remember, an account receivable is also an asset. And these are the assets. And do you see it's as of this date? And these are the assets. And then they're totaled right here, $61,000 in assets. Okay, these are the liabilities next. I owe on my car. I bought a car, but I owe on the loan. I owe on my credit cards. I owe a total of $10,600. So what is my equity as of March 31st? It's also known as capital. Well, since liabilities and capital have to equal assets, then owner's equity would be $50,400. That's pretty good equity. Okay, now we're going to talk about the income statement. The income statement shows how profitable you were within a certain period of time. So you always put the beginning date and the ending date. And so you could do it as of a year. Like, let's say my boss said, will you run me a profit and loss statement for last year? Well, what would be the first date? January 1, right? What would be the last date? December 31st. It would show all the income and all the expenses within those two dates. You don't always have to have it just for a year. You could have it for a quarter. So if it's March 31st and my boss says, will you run me a quarterly income statement? Well, quarterly. There's 12 months in a year. So a quarter of that is 3. So January, February, March is a quarter. So if I ran a profit and loss for a quarter, what would be the first date? January 1st. What would be the last date? March 31st. All the income and expenses paid within that time, that is the quarterly income statement. And like I told you, it shows how profitable the company did during that period. So you take your revenues, well, your total income, and you subtract everything that you paid out. And if it's a positive number, it is profit. If it's a negative number, they call that a loss. So this is the ABC company. Is this for a year or for a quarter? It's for the first quarter of the year. And the revenues were $145,000. Woo, that's a lot. And the interest was $165. So the total income was $145,165. Now, these are all the expenses, because if you see here, income minus expenses equals net income. I paid my employees $120,000. I had insurance, rent, advertising, auto expense. Now, this auto expense is not buying an auto. It means like putting in gas, doing a tune-up, because I don't know if you remember when we bought the auto, it was exchanging money for an automobile. But this is just the upkeep, the little, if it's under 2,000 and it's in the normal course of business, then you expense it. And telephone, this is when we paid our telephone bill. So our expenses were $128,150. And so if you take your income and subtract, our profit was $17,015. I don't know if that's a lot or a little, but that's what it is. Okay, we're going to review. Which financial statement is like a snapshot in time? Remember, it only has one date because it's like, as of that date, what are the assets? What are the liabilities? It's the balance sheet. If I make an income statement for the first quarter of the year, what dates do I indicate? What's the first date? If it's a quarterly for the first quarter, January, right? And how many months if it's for a quarter? 3 months. So January, February, March. So what's the last date? March 31st. So it'd be January 1 to March 31st. All the income taken in during that time, all the expenses paid during that time. What accounts are in a balance sheet? Remember? Now, I'll give you a hint. It is that equation that we learned a long time ago. Do you remember the equation? Assets equal liabilities plus capital. Well, those are the accounts that are in the balance sheet. Assets, liabilities, and capital. Which accounts are in an income statement? It's also called a profit and loss. Well, do you remember? You take the income and then you subtract any money you paid for the expenses and you get your what? Profit or loss. If it's switched, then you have a loss. The accounts are income and expenses. Yay!